Hi, this is James Shug with Westpac London's end of day report for Wednesday, the 5th of December. Look, equity markets are very muted again today. We had some decent data out of the US. The services ISM, or non-manufacturing ISM survey, rose from 54.2 to 54.7 in November, partially reversing its October dip. In fact, business activity rose to its highest since February, although the jobs component was a bit weaker. We had 118,000 gain in private payrolls reported by ADP. It's softest outcome for a few months. The new methodology that they use, that survey, is supposedly designed to better align ADP with the official payrolls data, but not the first print of it, but the ultimately revised data. Also, ADP isn't affected as adversely by bad weather as the official payrolls figures. ADP don't count as laid off someone who can't get to work because of the weather, whereas the official report does that. So we're still comfortable with our 70,000 forecast for payrolls on Friday. Other data included a 0.8% rise in factory goods orders. We had already had the durables component and a few other bits and pieces there. The European composite PMI was revised up in November from 45.8 to 46.5 because of a sharply stronger German services PMI reading. It's still a weak level for that composite index, still consistent with contracting economic output, but not as weak as previously reported. However, retail sales in Europe, Euroland, were down 1.2% in October. That's the third fall in the last 4 months, and they're running a 3.6% annual pace of decline, which is the equal steepest pace of decline since the middle of 2009. UK services PMI slowed to 50.2. That's its its lowest reading since the recession in 2009, apart from the snow-affected dip to sub 50 just for 1 month back in December 2010. So disappointing numbers on the UK economy there. And we also had the Chancellor's autumn fiscal and economic update. The government's now forecasting 0.1% contraction for 2012 and a slower 1.2% growth pace next year. And it means that they'll miss their previously stated target of getting the public debt to GDP ratio falling by 2016. It's now going to happen in 2017, so it peaks a year later than they had previously been hoping for, at 79.9% on their forecasts. That's it for the news today, from this part of the world. In terms of markets, we've got a 0.1% rise report on the FTSE in London, just ahead of the close. The French market's unchanged, German market unchanged, Spain down 0.5, and the Italian market down 0.7%, and the Dow's unchanged as I'm speaking at about 4:45. In terms of commodity markets, mostly negative. We've got oil prices down 0.8%. Gold's down 0.4% at $1,689 an ounce, so $87.77 for the oil price. Copper's up 0.4% today. The Aussie dollar, it's at 1.045. It's just actually fallen about 0.3% in the last hour or so since just heading into the London close. We had softer than expected GDP numbers in Australia yesterday, 0.5% growth versus 0.6%, which was the consensus forecast and ours. We get jobs numbers out in Australia Thursday. We're looking for a 12,000 fall in employment and a slight rise in unemployment to 5.5%. We've got the Reserve Bank of New Zealand policy decision too. They should be on hold. I didn't mention too, the US stock market actually did perform quite well earlier on because of that positive ISM non-manufacturing reading, but Apple stocks took a tumble. They're one of the biggest stocks, or the biggest stock in the market, and so the broader market lost that early momentum. I think an analyst said that Apple's share of tablet sales will be half what it is at the moment in a couple of years' time. So just what one fellow says about Apple can undo what good news does for the market. Okay, I'll leave it on that note. Back tomorrow.